For decades, the US dollar has been treated as untouchable. It is the world's reserve currency. Global trade runs through it. Commodities are priced in it. Central banks hold it. Investors trust it. But Robert Kiyosaki has been saying something very different. Robert Kiyosaki, best known for his best-selling book, Rich Dad, Poor Dad, has repeatedly warned that the dollar is not as safe as most people believe. His message is blunt. The real risk is not a stock market crash, it is currency debasement. And in his view, that process is already happening. Kiyosaki's argument starts with one core idea. Money is not wealth. Assets are wealth.
For some people, that's bad. But if you're a real investor, this crash could be the best opportunity you've ever.
He draws a sharp distinction between paper currency and tangible stores of value. In his framework, the dollar is not backed by hard assets like gold. It is backed by government promise and government debt. That matters because of how the monetary system works. When governments spend more than they collect in taxes, they issue debt. When debt expands faster than economic growth, it creates long-term pressure. And when central banks step in to buy that debt, effectively creating money to finance deficits, purchasing power can erode over time. Kiyosaki argues that this dynamic has been accelerating. Since the global financial crisis, the U.S. Federal Reserve has expanded its balance sheet dramatically through quantitative easing. During the pandemic, stimulus spending surged into the trillions. The money supply expanded at a historic pace. Even though inflation cooled from its peak, prices remain structurally higher than they were just a few years ago. And here's the key question he asks. If the cost of living rises permanently while your income does not keep pace, what happened to the value of your money? It shrank. Kiyosaki calls this a hidden tax, inflation quietly eroding purchasing power. He believes most people focus on nominal numbers rather than real value. They celebrate rising wages or stock gains without accounting for how much purchasing power the dollar has lost. In his view, the danger to the dollar is not sudden collapse, it is gradual decline. History provides context. Reserve currencies have risen and fallen before. The British pound once dominated global trade. Before that, other empires' currencies held prominence. Over time, excessive debt, military overreach, and fiscal strain weakened those systems. Kiyosaki often references this historical cycle, suggesting that no currency retains dominance forever. Now, does that mean the dollar disappears tomorrow? No. But his warning is about trajectory. The United States is running persistent deficits even during economic expansion. Interest payments on federal debt have climbed significantly as rates rose. Political divisions make long-term fiscal reform difficult. If debt continues compounding faster than productivity growth, confidence can gradually weaken, and currencies ultimately run on confidence. Let us pause here for a second. Most people think in terms of stock market risk. They ask, will the S&P fall? Or will there be a recession? Kiyosaki reframes the conversation. He asks, what happens if the dollar itself loses credibility? That shifts the focus entirely. Instead of asking which stocks to buy, he asks which assets preserve purchasing power, regardless of currency weakness. That is why he consistently promotes gold, silver, and more recently, Bitcoin. Gold and silver have served as stores of value for thousands of years. They cannot be printed. They cannot be created by central banks. Their supply grows slowly relative to fiat currency expansion. Bitcoin, in his thesis, represents digital scarcity, a decentralized alternative with a fixed supply cap. Whether one agrees with his enthusiasm for these assets or not, the underlying logic is consistent. Hedge against monetary debasement with scarce assets. He has been particularly vocal about what he calls fake money, meaning fiat currency that can be expanded at will. He contrasts that with what he sees as real money tied to limited supply. Now here's where his argument becomes more provocative. Kiyosaki believes that the next major crisis will not be a traditional recession, but a currency crisis. He argues that if governments continue printing money to fund deficits, bail out institutions, and stimulate growth, the long-term consequence is erosion of trust. And trust, once broken, is difficult to restore. But there's an important nuance. Currency danger does not always look dramatic. It can look like persistent 3 to 5% inflation over many years. It can look like housing becoming permanently unaffordable. It can look like groceries doubling over a decade while wages lag. Gradual erosion is less visible, but powerful. Imagine saving cash for 10 years in an environment of steady inflation. Even if the banking system remains stable, your purchasing power declines meaningfully. That is the scenario Kiyosaki warns against. He often criticizes traditional financial advice that prioritizes saving dollars in bank accounts or bonds without considering real returns after inflation and taxation. In his framework, savers are punished in inflationary systems, while asset owners are rewarded. That belief shapes his strategy. He advocates accumulating income-producing real assets, rental properties, businesses, commodities, that can adjust to inflation. If rents rise with prices, real estate income can offset currency erosion. If commodity prices rise, producers benefit. He views debt differently from most conservative financial advisors. In an inflationary environment, fixed-rate debt can actually become advantageous because it is repaid in cheaper dollars over time. This idea flips conventional wisdom. Instead of fearing all debt, he distinguishes between good debt that finances appreciating assets and bad debt that funds consumption. But let us challenge the narrative. The US dollar remains deeply embedded in global finance. It accounts for a majority of global reserve holdings. It dominates international trade settlement. US Treasury markets remain among the most liquid in the world. So when Kiyosaki says the dollar is in danger, he is not necessarily predicting immediate displacement. He is predicting weakening purchasing power and rising systemic stress over time. And there are legitimate concerns supporting that caution. The national debt has surpassed historic milestones. Political gridlock complicates fiscal consolidation. Entitlement spending pressures are growing as demographics shift. Interest expense consumes a larger share of federal revenue. If growth slows while borrowing continues, fiscal math becomes more challenging. Kiyosaki's critics argue that he has predicted collapse for years and that the dollar remains strong relative to other currencies. That is true, but his argument is less about relative strength and more about absolute purchasing power. If every major currency is being debased, being stronger than others may not protect real wealth. Here's a powerful mental shift. Instead of measuring wealth in dollars, measure it in ounces of gold, barrels of oil, acres of land, or shares of productive businesses. How many tangible units can your savings buy today versus 10 years ago? That is the lens he encourages. Now consider the geopolitical angle. Rival powers have explored alternative trade settlement systems outside the dollar. Some countries are increasing gold reserves. Discussions around digital currencies, both centralized and decentralized, continue evolving. While none of these developments dethrone the dollar overnight, they signal diversification. Reserve currency dominance erodes gradually before it shifts meaningfully. If you're still listening, ask yourself this: what percentage of your net worth is tied entirely to the purchasing power of one currency? That is the vulnerability Kiyosaki highlights. His solution is diversification into scarce, tangible, and productive assets. Gold for stability, silver for industrial demand and scarcity, Bitcoin for digital hedge, real estate for income and inflation pass-through, businesses for cash flow. But here's something important. Kiyosaki's philosophy is not just about assets. It is about financial education. He argues that most people are never taught how monetary systems work. They're taught to work for money, not to understand how money itself functions. When central banks expand the money supply, when governments run deficits, when bond markets influence interest rates, these dynamics shape daily life. Yet most people only react after consequences show up in their grocery bill. His warnings, dramatic as they may sound, are essentially urging awareness. Understand the system. Understand inflation. Understand debt dynamics. Understand asset protection. The dollar may not collapse tomorrow, but if purchasing power continues eroding steadily over years, the effect compounds. And compounding works both ways. It grows investments, and it shrinks currency value. Robert Kiyosaki's message is not comfortable. It challenges traditional savings advice. It questions monetary stability. It encourages skepticism toward fiat systems. But at its core, it is about control. If the dollar weakens gradually, those who hold only cash lose quietly. Those who own productive or scarce assets adjust. So when he says the dollar is in danger, he's not shouting about chaos in the streets. He's warning about erosion, slow, persistent, and powerful. And in finance, the slow forces often matter more than the sudden ones.